Since XLU is a utility sector ETF, it will mainly have stable movement and low activity when compared to most other ETFs, and especially individual stock charts. That doesn't mean it is immune to large drops or rapid movement. It will just be less common to see such price behavior. Trading is neatly contained in a triple bottom range that begins a steady uptrend, carried on by double and triple top ranges that fail to produce bearish reversals. Late August to November is a fairly volatile period compared to normally stable movement on the chart. The wide fluctuations in a concave and declined triple top mark the head and right shoulder area of an inclined head and shoulders reversal that has multiple downswings comprising the shoulders. Interestingly, the whole formation begins with 3 methods rising price action in early September and ends with the polar opposite of 3 methods falling price action into November. It is a great example of a gradual transition into a downtrend. Despite the fairly messy fluctuations, price is generally contained within the broad outlines of these bearish reversal patterns. Given the stable uptrend over the past year, it is less of a surprise to see a weaker drop into November. It is still normal to see a pause in the short term due to recent resistance, centering on the 6480 level. Bullish volume is also overwhelmingly consistent, but is at lower levels due to the holiday period at the end of the year. 2 relatively weak bearish spikes have relatively little effect, given the broader bullish context that continues into the new year for a likely failed double top. A steady row of green presents a rapid but still stable acceleration to new highs. At this time, the utility sector and broader stock market experience a rapid shift to bearish conditions. It is at this point where XLU drops onto the first key long-term support marked by the failed double top. In the event the overwhelming bearish acceleration continues lower, it is likely the utility sector and broader stock market can fall into medium to large correction territory. A comparatively weaker bullish retracement is normal to see around the first major support range. It is also normal to see the bull hammer on February 28th not form directly in the range due to bearish volatility. This is more of an approximation, as precision, like on other charts, is almost thrown out the window during bearish volatility, like on this current chart. Though there are no clear swing points around 6880 in January and February, the highest point of the bullish retracement is validated to an extent by running through an area where price had recently stalled, with more neutral to bearish price action before the ultimate peak. It was certainly no classic head and shoulders, but the gradual transition into a downtrend is similar. Now the gap fill and the descending trend lines offer firm support to the passive recovery after selling pressure had been significantly exhausted. The initial uptrend is also over, as even the shallowest uptrend line variant is broken. This was mainly a gap fill, but there was also a minor triple top. The actual triple top is more apparent and accurate when looking at a candle chart. Closing prices are often less precise in cases of compact patterns, where candle detail is more important, though a line chart of closing prices does still highlight the neat containment of price action in the range. The 5750 gap down level is also conveniently reused as the triple top's lower boundary. Price eventually does clear 5750 when it offers brief resistance. Then selling pressure remains constant to keep the chart relatively neutral to bearish towards August. As the 57 level holds and is followed by another stable bullish acceleration, it is helpful to adjust the uptrend line as selling pressure returns with strength. The lower boundary of this bearish reversal range is expanded due to the minor gap up and the close proximity of the major 64 to 63 range, offering immediate support potential. Whether the long upper wick on November 9th is counted as a downswing for a triple top doesn't matter that much, since the focus of any bearish reversal range is on the lower boundary. The only viable downtrend line comes from the long upper wick and the final clear downswing, as the downtrend is firmly established under 63.74 with 3 methods falling price action. Interestingly, the 3 methods falling formation ends with 2 smaller candles, rather than the more common sight of one large red candle. This may be attributed to lower volume ending November around the Thanksgiving holiday. Towards 2021, there is a double top reversal under the stronger resistance potential of the downtrend line intersecting with the 63 level. This also produces aspects similar to a failed ascending triangle due to the noticeable incline from February that is broken. At the time, the large ascending triangle outline was not as apparent, if too much attention was zoomed into the short term during mid to late 2020. As usual, there can be several outlines for the triangle, depending on how the incline is defined.